What happens when the economy collapses? As it turns out, a lot of really bad stuff. For absolutely no reason in particular, here are the worst things to have ever happened during a stock market crash. One important aspect of the success of many financial scams is that many people don't understand complex money movements, often becoming bored when someone tries to explain them. Not for nothing, but this is the exact reason why Margot Robbie shows up in The Big Short.
Got it? Okay. Now off.
If you need proof of how far some people can go when nobody's paying attention, just take a look at the Black Friday of 1869. But very simply, here's what happened. Two already wealthy men, Jay Gould and James Fisk, thought they could enrich themselves even further by manipulating the price of gold on American markets. At the time, the U.S. was selling gold in regular tranches to pay off its Civil War debts. If the price of gold went up, greenbacks would go down, making American exports more attractive. Gould and Fisk would benefit both from increased use of their railroads for exports and from the spike in value of the gold they held. Even better for them, Gould and Fisk had a mole in the Treasury who would alert them to the government's plans. Unfortunately, though, they ended up getting greedy. When their scheme was uncovered, President Ulysses S. Grant attempted to foil them by releasing a then considerable $4 million in gold reserves to drive the price down. Gould and Fisk's plan collapsed, and so did the markets. For their part, the two men who caused it all got away without any real consequences, although Fisk was murdered in a fight over a woman 3 years later. The months of financial chaos that followed were the last thing the U.S. needed so soon after the end of the Civil War. Reconstruction was still in effect, with most of the former Confederacy still occupied by federal troops. A second financial panic in 1873 sapped the public appetite for Reconstruction even further, and the project ended for good in 1877. The memory of the wealth and excess of the roaring 1920s has endured even into the 2020s, a decade that, let's face it, has been much less roaring.
Fireworks!
The music always stops eventually, though, and the giddy jazz of the 20s ended with the mother of all record scratches on October 24, 1929. Black Thursday was the beginning of the largest stock market crash in history, a meltdown so epic that it became one of the most significant causes of the Great Depression. The wealth of the 1920s didn't have much of a solid basis in productivity booms, and so the sky-high prices of many stocks in 1929 were underpinned largely by optimism, which isn't exactly a durable economic good. A number of minor sell-offs in October 1929 quickly snowballed into one another, and the situation was worsened by the fact that many stocks at the time had been purchased on margins. This technique involves investing with borrowed money on the assumption that an asset will rise quickly enough for profits to cover the vig. The analog technology of the day couldn't keep up with a growing number of people hoping to sell their stocks, which first swooned, then fainted, then collapsed entirely. As the confusion and chaos grew to a fever pitch, police were sent to Wall Street to suppress any potential disorder. The chaos calmed down a little on Friday, but the next week saw further punishing declines in stock indices. Economists and historians chicken and egg the 1929 crash and the subsequent depression, with some arguing the crash did not cause the depression, but rather happened because the depression was about to unfold. Regardless, the stock market crash of 1929 has long been regarded as the first major sign of the Great Depression. The first 8 months of 1987 were great for stocks, and those who sold before August would have walked away with attractive gains for the year to date. The rest of the investing public, however, was in for an unpleasant surprise. Disappointing figures for the U.S. trade deficit combined with other scraps of pessimistic news led to a 4.6% drop in the Dow Jones on Friday, October 16th. On the morning of Monday, October 19th, markets in Asia and the Pacific plunged, setting U.S. markets up to tank at the opening. And tank they did, plummeting over 20% on the day.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points.
The crash of 1987 led to a number of reforms in the market, and most of the losses were recovered fairly quickly. Most prominent of the new rules were the so-called circuit breakers, which are still used today. The circuit breakers automatically stop trading for a period of time if and when markets fall by a certain amount. These can apply to individual stocks, but the ones that usually cause comment if they're triggered are the market-wide stops. A 15-minute pause in trading occurs if the S&P index tanks below 7% from the previous day. It happens again if the index keeps falling past 13%. At 20%, trading is done for the day to prevent or forestall a crash caused by panic selling. In the late 1990s and early 2000s, people were very excited about the internet, although they didn't really know what to do about it. There were plenty of ideas kicking around, though, and anyone who could put together a website could ride the cresting wave of the new internet economy, or at least appear to. Because the whole idea of internet commerce was so new, people didn't really know how to evaluate if a business plan was any good or not, and investors ended up pouring money into businesses that sounded cool but didn't make any actual profits. Here's a fun financial fact for you. It's pretty hard to keep a business afloat if you're not making money. And that's exactly what investors learned when the internet bubble burst in 2001. An interest rate increase spooked investors, and as they began to sell, the tech-weighted NASDAQ began to drop like Wile E. Coyote, losing nearly 4,000 points between the March 2000 peak and the October 2002 trough. Many so-called .coms went bust, including pre-Google search engines, semi-illicit music streaming services, ahead of its time pet supply service Pets.com, and an early form of web currency called beans. In 2007 and 2008, the global financial markets came very, very close to collapse.
Who was the brilliant person who came and said, let's do credit default swaps? Find him. Fire him.
American banks had grown too big and extended their credit too freely. As a resulting downturn rolled through the American economy and spilled out across the world, the Great Recession began. This recession was the worst financial disaster since the Great Depression, and while most countries were affected to at least some degree, Iceland was one of the worst hit of all. Prior to the recession, Iceland had tried to generate more wealth by growing its banks, franchising them into other countries in the hopes of emerging as a financial power. Unfortunately, when the crisis hit, these banks were operating in foreign currencies that Iceland itself could not influence. And so Iceland's banks fell apart over the course of a single terrible week. As you might expect, this annoyed a fair few Icelanders, who from October 2008 began to gather outside government buildings to call for a change in leadership. The largest crowds reached 6,000 to 7,000 people, possibly representing over 2% of Iceland's population. In total, it's believed that 25% of Icelanders may have participated in the protests at some point or another. And it all worked, too. In January and February 2009, the Icelandic government and a number of key financial regulators all resigned. In the years to come, a total of 36 Icelandic bankers would be sent to prison for their roles in the country's economic collapse. The 2008 crisis strained public budgets within the Eurozone, especially in a group of countries that became known derisively as the PIIGS: Portugal, Ireland, Italy, Greece, and Spain. Cyprus also got in some trouble, but apparently that wasn't enough to warrant wrecking the acronym.
That'll do, pig. That'll do.
Of these troubled countries, Greece grabbed the most headlines, as low tax receipts, stock market dips, and ever higher sovereign debt burdens pushed the country toward total collapse. Austerity measures imposed by the government soon triggered strikes and unrest, and people began to float the idea of Greece simply leaving the Eurozone altogether. Theoretically, a restored drachma would replace the euro in Greece and fall in value pretty quickly, making Greek holidays and exports attractive for people whose euros would suddenly go a lot further. After a few unpleasant adjustments, this would bring investment into Greece and allow the country to recover. The flip side, of course, would be a potential crash in living standards and a feared drift away from Europe and NATO. Eventually, Greece began to recover with the help of other European countries, most notably Germany. This was somewhat uncomfortable for Greece, whose politicians have long argued that Germany owes Greece financial reparations for the Nazi occupation during World War II. Nothing else, though, Greece has since managed to remain inside the Eurozone. Considering they're so closely associated with the Netherlands, it's a little surprising that tulips aren't actually native to the country. In fact, the tulip comes from the mountains of Central Asia. The flower was brought to Byzantium sometime during the Middle Ages and came to delight the Ottomans as they consumed the last of the Byzantine world. So when the Dutch became rich after securing independence from Spain in the 17th century, they began buying pretty things from faraway places, like Turkey. The conventional wisdom goes that drunk off both the beauty of the tulip and their own ability to create futures markets, the Dutch population briefly went absolutely nuts buying and selling tulips. This in turn created a speculative bubble now commonly referred to as tulip mania. Everyone was in on it, putting everything they had into tulips, hoping especially to buy a bulb that would produce a prized striped blossom. When this runaway speculation became untenable, however, the bubble popped and everyone lost their little Dutch shirts. Sadly, for those of us who love a good yarn, this story is something of an exaggeration. There certainly was some wild and wacky speculation on tulips, but the collapse in prices wasn't the ruinous event it's often made out to be. Some of the most overblown examples of people betting it all on bulbs actually come from Calvinist propaganda intended to make everyone calm down and start thinking about hell again. In fact, no record survives of even a single flower trader going bankrupt in all of the Netherlands. The French King Louis XIV loved his mistresses, his palaces, and especially his wars. Unfortunately, these are all expensive vices, and so when the king died in 1715, France was more or less out of money. That's when a Scottish huckster named John Law sidled up to the Duke of Orleans, who was acting as regent for the young Louis XV. Law spent the next 2 years setting up a bank, printing and distributing paper money, and establishing a company to monopolize trade with French Louisiana. Soon, this company controlled all exterior French trade and had even taken on France's national debt. This essentially means that within 3 years, the entire economic management of a major colonial power had been signed over to some random dude. And when said dude mishandled the situation by overvaluing stock shares and printing too many paper bills, the whole shebang collapsed in a puff of hyperinflation and devalued assets. The French government had to reimburse angry investors in order to calm the storm, which did very little to improve the country's financial situation. Law himself fled France, dying poor in Venice a few years later. Oil companies are perhaps not the most sympathetic victims of the early COVID market uncertainty, but the sudden drop in oil demand brought about by a global travel slowdown did put them in an awkward spot. Oil extraction can't be turned off right away, and major suppliers Russia and Saudi Arabia bickered about how much and for how long to cut oil supplies in the face of the crisis. Soon enough, the global economy began to find itself with too much oil on hand. This whole situation led to a free fall in oil prices, including one particularly strange phenomenon. For a short period of time in April 2020, the type of oil known as West Texas Intermediate was trading at negative prices. Theoretically, you could have gone to an oil supplier and had them give you a barrel of oil and $37 for your trouble. Eventually, of course, people began to use oil again and the situation righted itself. But the negative price of a benchmark type oil underscored just how weird the world became in the early 2020s.